Welcome to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
How long does this music go for? I've never let the full thing run.
As long as we want it to, Tom. As long as we want it to.
Yeah, I feel like one week we should do an encore and just have that guy play a couple times in a row. Get a couple rounds of intro going in there.
Yeah, Jack would never let that fly, but we could probably do something like that.
Jack's far more professional than all the rest of us, especially me. So yeah, that's cool. We're a bit short on people today, Brad. We had hoped to talk about China recovery, as is in the title. I think that was a topic suggestion from Karan, but Karan may pop in. We'll have to see. We had some bank earnings come out this week. One of the banks I follow, Hingham Institution for Savings, reported this week, so we can maybe touch on that. And then, yeah, I think, Brad, both of us keen to just take as many kind of audience questions as we can.
Absolutely.
So if people have things on their mind that they want to hear our thoughts on for whatever reason, pop those in the chat, and we'll see what we can do. Brad, did you have anything to say on the kind of China recovery topic suggestion we had? You were telling me the extent of your knowledge a little bit before this. Maybe you can share what's been happening there.
Yeah. So I still own Alibaba and Tencent through Prosus, and I have not. We already have a super chat.
Super chat.
It's incredible.
Can you just tell us that person's name 10 times fast, Brad?
Gigi Luigi PG. I can do it one time somewhat fast.
Okay. Thank you very much for the super chat. Is that yen?
Yeah.
1,000 yen. Very nice.
Yeah, look at that. Yeah, so I still own those, but it's not something I've paid any attention to recently. It's just kind of a set it and check back in a year or two. So I haven't been following. I'm pretty sure Karan still owns that basket in China. Is that right? What's that ETF he's using to bet on?
KWIP.
KWIP.
He owns KWIP.
Yeah. So if he pops in, I assume he'll have some things to say about it, but
yep,
it's on my set and forget list.
And Brad, did you say you own Tencent, or is it you own Tencent via Prosus, or do you
through
own
Prosus? Yeah,
a bit of both?
through Prosus.
Okay, none direct. I think Frank maybe in the past has talked about splitting that in his portfolio, but
right. Yeah, not me.
Just purely Prosus.
Mm-hmm.
Yeah, cool. So what's planned from here? Just kind of let it ride, look at the earnings or something from time to time, and
yep.
What's sort of the check-in frequency plan? Once every 6 months, once a year?
At this point, it's about once a year. So
yeah.
Nice.
And is there anything in particular you're sort of looking out for, to make sure things are tracking well? Any like red flags in your annual check-in that you'd be watching out for?
Well, I guess a big red flag would be if Daily Journal sells. That'll get my attention. Or if Pabrai sells, Prosus, but I don't know that we'd even know if that happens because he's not required to disclose that. There's other things I'm gonna dig it into at this point. I'm leaving the China stuff to just ride.
Nice. Yeah, I'm in a similar position. It's not a huge position for me, partially because it's gone down so much, partially because I've been earning money and the sort of general pie has grown. But I've liked what I've seen. I've liked what I've seen in particularly the last kind of earnings that came out of Alibaba. So for anyone wondering, that's my only exposure to one of these Chinese stocks. I've never been in Tencent or Prosus. I just felt I could get my head around Alibaba a little simpler, so chose to go kind of purely for that.
You didn't chase it down, huh? Chase it down the rabbit hole.
I didn't know. You mean sort of averaging
price wise? Yeah.
Mm-hmm. Yeah. I think my cost basis is very roughly 200, maybe slightly lower. I did add a little at maybe 95 or something like that. Somewhere in the first half of last year, I think. But yeah, I didn't average down. I didn't want to get overexposed to it. I felt there were other things I understood better that I could buy at that time. So yeah, that's where I'm at with it.
One of which might be a company we're talking about today.
Yeah, that's a relatively small position, but that is a new one. I've also added to my beloved company that should go unnamed because I talk about it too much. But yeah, that's kind of
a reputation. Huh?
Yeah, no, it's bad. I don't want to be one of these people who like
talk your book,
whose whole identity becomes a single stock. I don't want to be that person. What was I going to say? Yeah, I did like what came out in the last quarterly earnings from Alibaba, though. They turned off a lot of their spend on acquisitions, which used to be just impossible to keep up with. They're acquiring so many companies. A lot more cash going towards share repurchases, which I like, although it's offset a fair amount by the kind of stock-based compensation and the dilution from that. And they seem to kind of broadly across the business have a lot of cost-cutting initiatives. So even though revenue was largely flat last quarter, the operating income was up fairly nicely. So
nice.
Yeah, it'd be good to see that trend, and it'll be interesting to see what happens for the underlying business with, China reopening as a general sort of trend as well. I think it's been really hard to take anything too meaningful out of the last few quarters results, even though I just mentioned a few good things earlier, because they've been operating in a pretty weird environment.
Right. Absolutely.
Yeah. We've got a very nice comment here from the Art of Value. Top tier YouTube duo. Thoughts on that, Brad?
Thoughts on that? That is spot on. Spot on.
Is that highly accurate? It's been a while since just the two of us have done a live stream. I think the first one was Seritage 2020 or something.
That sounds right. And then I think I came back. I did one more, but that may have been the same year. So yeah, it's good to be back.
Time flies. Absolutely.
It sure does.
Let's take maybe this one from Rohan. What are lessons you've both learned from the ups and downs of China tech stock prices?
Yeah.
What do you think, Brad?
Well,
you seem very zen about the whole thing.
Yeah.
Is that what you've learned?
No, I'd say one takeaway from that is, personally, I've been focused much more on U.S. companies. I think if I'm invested in a geography, a political environment that's really hard for me to wrap my head around because I haven't spent time there, and stocks start tumbling, it's like it's much more difficult to kind of maintain that equanimity in that kind of situation, just because there's a lot more I don't know what I don't know being in a place like China. So that's sort of a reorientation I've had ever since buying Alibaba and Prosus is, there's a lot that could happen here that isn't even on my radar. And so I think it's just made me a bit more focused domestically.
Yeah, I would tend to agree with that. And I think it's made me focus potentially on like simpler businesses. There's just so many moving parts with something like Alibaba.
Right.
Yeah. I mean, it's one data point. Like, I don't think you necessarily want to learn too much from the whole thing.
Sure.
Yeah, I had quite a good question on a Q&A video that I think I would have just been released this morning, which was something along the lines of, what do you do in a situation where you buy into a stock that you think is cheap and a good business, the business doesn't perform quite as well as you maybe first anticipated, but the stock price performs even worse than that. And you get into a situation where, like, even though maybe intrinsic values deteriorated slightly, the market prices deteriorated way more. And I felt that guy was relaying exactly what had happened to me with Alibaba. Right. I don't know if you have any take on that. My answer was kind of hesitant to add to it because there's been a bit of deterioration that I didn't expect. But also hesitant to sell the thing.
I do have a thought on that. So I just put out a video on Michael Burry today. I was reading through his investment strategy. It was posted on Twitter by Brandon Balo. And I didn't realize this is from like 2001, 2002. Burry kind of published this. I thought it was more recent, but I was reading through it. And at the end, Burry talks about, not stock picking, but how to manage the portfolio. Because to Burry, that's as important is kind of portfolio management as stock picking. And one of the things he said really struck me. It was, he's basically looking for roadkill. He's looking for things that nobody likes, which makes a lot of sense. But he wants to see some support at the 52-week low. So he likes to buy things between 10 and 15% from the 52-week low, which is really an indication that this thing is very out of favor, but it's not the lowest it's been in the last year. And what he'll do if after he buys it, the price drops below the 52-week low, he'll usually cut his losses. And, I have mixed feelings about that, right? As a kind of long-term investor, I'm hesitant to entertain the idea of a stop loss or something like that, because, if something's volatile and you believe in it, right? You believe in your thesis, it can go much lower before it gets to its intrinsic value. But at the same time, you can also be completely wrong about a business. And so, I was intrigued by the way he plays that, by the way he caps his losses with that approach. So it's something I've been thinking about.
Yeah. Is technical analysis something you'd ever entertain, really, or not?
Well,
you don't
it's
seem
something
like
I'm thinking about. Only that aspect appeals to me, in terms of capping downside. But yeah, it's not something I've implemented, but it's something I didn't expect to be intrigued by, and suddenly I'm a little intrigued by it.
Yeah. To me, it seems like it's hard enough to figure out the economics of an individual business, let alone steer at moving averages and things as well.
Right.
Totally. But you never know.
Yeah.
Right. Any last thoughts on Chinese tech, Brad? Before I talk about the subject everyone loves, which is small cap banks.
Your favorite little bank? No, let's jump into that.
Okay, that's cool. We can loop back around to some questions and things if people have got them on that topic as well. Right, let's share that one. Are you now seeing a press release from Hingham?
Yes, I am.
Perfect. So, I thought I'd just briefly talk through this. So, Hingham Institution for Savings, which is a little bank in Massachusetts that is pretty small cap. I think it's a little under a 600 million market cap, but it's down a fair bit. It was probably over $1 billion at peak, or at least very close to it. And it seems to be followed by a lot of Buffett type style investors. It's it also seems like there's a bit of Buffett influence in the management team as well, which is kind of nice in the way they sort of are quite conservative about running the business. But they reported their results this week. I thought it'd be interesting just to go through some of the highlights from it, literally, because I've highlighted some things here, and maybe I'll share some thoughts along the way. So for those that don't know, Hingham are a very simple bank in terms of the way that they operate. So on the loan side, purely all they do is real estate lending. They don't have they don't do car loans or personal loans or, lend you money for a boat or to start a business or anything like that. It's purely just real estate lending. So it makes it reasonably simple to analyze. Also means they've got some, tangible assets behind their loans should things sort of go south as well. The thing that Hingham are quite exposed to, which can be a positive or a negative, just depending on which direction things are moving, is short-term interest rates. So, they're paying money out on deposits and so on, which tend to be relatively short-term in nature, and then they're making relatively long-term loans on the real estate. So they can be pretty significantly impacted by, just short-term interest rates going up. That can be a significant cost increase for Hingham, or short-term interest rates going down can be a immediate cost saving for them quite quickly. So it's just interesting to see how they kind of cope through some of these different environments, because 2022 was a year where we saw a pretty rapid rise in short-term rates, and that as a headwind for Hingham.
Hey, Tom, quick question from the chat. Is it residential or commercial? What kind of real estate are they making loans on?
I believe a mix of both.
Okay.
Yeah, don't know those numbers off the top of my head, though.
Cool.
So just to walk through, I guess, bank's average return on equity for the year was 10% compared to 20% in the year prior. So 2021 was almost the exact opposite in terms of financial conditions for Hingham, where there was still kind of a decline in interest rates. Like, they had a huge benefit from COVID when short-term rates basically went to zero. They had very low-cost funding. And the other thing that's a little unique about Hingham is they also have a stock portfolio that's still under $100 million. So we don't get a 13F and we don't exactly know what's in there. But their returns on equity are influenced by what their stock portfolio is doing as well. So that means they had a 10% return on equity, but the return on equity for the bank's core operations was 14%, which tells me they probably experienced some losses in their stock portfolio in the year, but the core kind of banking business is producing a 14% return on equity. Just walking through some other aspects of the earnings that kind of jumped out at me. Loans grew 22%, which was really strong growth. So concentrated in multifamily and commercial real estate. A little concerning is that their deposits only grew 5%. So, you'd like to see those grow ideally in line with their loan growth. But that's kind of where that stood. Book value grew 9% for the year, and over the past 5 years, book value's compounded at 15.5% per year, and banks are generally valued on a price to book type basis. So they flag that as quite an important sort of long-term metric for them. The other thing I might just jump to is, Brad, we were talking about this a little bit before. So one of the things I quite like about Hingham is they have very disciplined loan underwriting, and compared to most banks, they have very few of their loans become non-performing to where they're not going to get paid back, or the bank has to, foreclose on property and that sort of thing. So the bank did not foreclose.
Non-performing means defaulted, basically, right?
I probably couldn't tell you the exact technical definition off the top of my head, but that's how I kind of think about it.
Yeah.
So yes, in the previous year, they had 0.03% of the loan portfolio as non-performing loans. This year they had 0.03% compared to 0.01% last year. So it's tripled, but triple nothing is still not much. That's very low compared to most banks. So that's quite interesting. The other area where Hingham really excels is just kind of their cost of operations, which is primarily measured in this industry by something called an efficiency ratio. That's kind of a cost relative to the money that they're bringing in. So the lower the better, ideally. Efficiency ratio was up, but that is quite significantly influenced by the net interest income, which we've talked about. Short-term rates going up had a bit of a hit on that, or had a bit of an impact on that this year. So they kind of look at it as operating expenses as a percentage of average assets, or as a percentage of their total loan book and stock portfolio, I guess, as well. And that was down slightly, so 0.7% versus 0.74. So that's kind of moving in the right direction. And just to jump to some of the core numbers which tell quite a story here, so hopefully you can see this okay.
Yeah.
But this is basically the loans that they had written and the deposits that they're kind of paying interest on, and other borrowings that they're paying interest on this year versus last year. It tells quite the story here. So on the loan side, they were earning 3.68% on their total, on all their interest earning assets at this time last year. That's gone up a little bit, but only to 3.9%. Small gain there. But in terms of their interest bearing liabilities, so things Hingham are paying interest on, it's gone from 0.3% to 2.2%. So massive jump up there. And that's what I say when that's what I mean when I say Hingham is quite exposed to short-term rates. So that flowed through this year. But I mean, overall, they still seem to have pretty disciplined, loan underwriting. Costs of running the business seem to be going down. And they still generated a 10% return on equity, which, given all the things that happened in the year, I would argue is a pretty reasonable result. So yeah, that's my little run through of Hingham earnings. I thought that one might be interesting to share.
Yeah. So what's the current price to book? Is that kind of how you think about what the, whether it's fairly valued or?
Yeah, I know there's people that prefer things like price to customer deposits and that sort of thing. I've never quite been able to get my head around that. I think price to book's simpler personally.
Yeah.
But let me just check. I think it's a little over 1.5 times price to book.
Yeah, it's 1.57.
Have you got some long-term averages or anything on that handy, Brad, or not?
I'm just on Ticker. It might be easier for you to pull it up rather than deal with the whole screen sharing thing.
Okay, cool. Hopefully people are seeing that. I might just put that on a small screen, actually. Cool. So yeah, Hingham, let's go 10 years price to book. Yeah, 1.57.
Wow. This is 10 years. Okay.
Yeah, this is 10 years. The mean is 1.9. Yeah, you did very well if you bought it in COVID when it got down to 1.1 times book, and the underlying business was just about to have a very good year because short-term rates went down so much. It got up to like 2.6 times book. So yeah, that's where that's at. There's a few types of businesses. I think banks are one that makes sense. There's some other businesses where I think it makes sense, but kind of looking at the relationship between price to book and just what the underlying return on equity of the business is, I think is a good way to kind of look at it. So, you're paying 160 cents on the dollar, call it, for each dollar of book value. And that book value is earning 10% a year. So that's kind of how I do that valuation equation in my head with this stuff.
We got a question from Ba. How are they planning to grow? Did they say anything about that?
Yeah, they have just expanded into some other regions, which is exactly what
Rohan look at that.
Here. So yeah, I honestly don't have too many concerns on the loan growth side. I think they can just continue doing what they've always done there. I mean, just to show like what the growth has been like, because it's been a pretty epic run, even though they've been paying out special and regular dividends all along the way. If we go tangible book value per share over a long time, it's been really consistent.
Yeah, I see
double digit and a little bit growth. So yeah, I don't have too many concerns about their ability to grow loans. The growth in deposits is one that does concern me a bit. That is definitely a weaker area for Hingham. Like we saw it, we saw it this year where they had 20% loan growth and only I think 5% deposit growth. So they have to look for other sources of funding, which are generally more expensive than deposits if they don't have the deposit growth keep up. But yeah, that's the short answer to that question on growth.
Okay. Great.
You ever looked at banks, Brad?
No, I don't. I don't look at banks. There's just too much. There's too much kind of behind the scenes. It's I just can't wrap my head around them.
Mm-hmm. Too many moving parts.
More just like it's hard to get into all the loans and gauge how risky they might be. I'll leave that to Michael Burry.
Yeah, fair enough. I honestly am largely in the same boat. I think like I would struggle with Bank of America or Wells Fargo or something, because they're so substantial, and there could definitely be some like financial weapons of mass destruction we don't know about under the hood.
Right.
I think with something like this, maybe it's more straightforward because they're doing one or two things, and same family's been running it for, I think, must be 28 years or something at this point, and has a good track record. So I like that, but.
Yeah, and it helps to be able to see, that they got through 2007 and 8 seemingly unscathed. So that's a big plus.
Yeah, for sure. All right, that's about all I had on banks. Should we take some questions?
Yeah, let's ramp up the questions here.
Yeah, cool. Yeah, any topic people like, just throw a comment in there, throw a question in there, and we'll see what we can do. Here we go. This is one for you, Brad. This is right up your alley. Would you ever consider just solely cloning as a strategy, such as the Bryce free lunch portfolio?
Yeah, I've been noodling with the idea of creating sort of a side portfolio that's really based on cloning. Maybe a couple other rules in there in terms of when to buy and sell, just to see how that does. So it would just be a small part of the overall portfolio to begin with. I don't, if it works, I have no problem putting all of it into a strategy. My ego isn't in this where it's like, hey, I'm only going to go a certain route if, it's my idea and I've, figured something out. It's for me, it's really about what generates the best returns for me and kind of checking my ego at the door. So yeah, I'm all about testing different approaches. Of course, you want to understand, the reasoning behind the approaches. Otherwise, it's going to be very hard to stick with. But I would consider it if it seems like I can come up with an approach that makes a lot of sense to me.
Very cool.
I don't think it would be the free lunch portfolio. There's a few too many moving pieces to that. Yeah, it's not. There aren't clearly defined rules for it. It's just kind of like, how's Pabrai feeling this year about certain things? It's a little too loose for my liking.
Yeah.
But I appreciate that he's doing it and putting it out. I think it's a fun experiment.
Yeah, for sure. Well, I mean, I've been running a similar experiment. I've got the Shameless Clone portfolio series,
right?
Which interestingly, this isn't the first time it's happened, but just recently, largely driven by the China stocks rally, I think to a pretty significant extent, I've pulled ahead of the S&P 500 again, which is nice in terms of all-time performance. So I'm just looking at the numbers on Sharesight here. I'm down 4.6% versus down 7.5% on the index. I think those are annualized numbers over a year and a bit or something.
Yeah.
So yeah, that series has actually been really interesting to just document some of the challenges with shameless cloning.
Yeah.
Like I haven't come to the next quarter to make a video on it yet, but I will talk about it when the next batch 13Fs come out. Like Brookfield went into the portfolio a quarter ago, for example, and they've just gone and spun off their asset management business. So I sort of had to go through how I managed that, trying to be a shameless cloner with complete going in completely blind as to what Pariah's doing with that holding, because he was where that idea got cloned from. So there's some interesting challenges there, but
totally. Yeah. How do you not let the bias creep in, right? Yeah, it's interesting.
For sure. All right, what else have we got?
Alexander, did you want to say anything about the Paramount Ted Weschler trade? I haven't spent any time on Paramount. The whole sector kind of, I'm tempted to just stay away from it, ignore it entirely. But any thoughts from you?
I did listen to Jason's podcast, Afternoon Investor, on this, because he did an episode on Paramount the other day. I think it's like a north of 10% position for him now.
Okay.
They do seem to have quite a bit of underlying real estate, so that's maybe something to include in your analysis for people looking at it. I don't have a strong view on streaming. If you force me to pick one, I'm probably a Netflix guy, to be perfectly honest.
You and Hamish.
Hamish more than me. But, I think they've got probably the clearest path forward. It's a bit more uncertain, I think, where some of these other newer streaming services end up, although doesn't necessarily mean it's risky. And that, I think, is what Jason actually titled his podcast episode, maybe like low risk, high uncertainty with Paramount. Right. So people should go and listen to that for more intelligent thinking than we can probably offer on Paramount here.
Yeah. Do you know, are they currently trying to unlock some of that value in the assets, or is that just kind of like if they need to? Or
I think most of it is if we need to. There may be like a couple sale and leasebacks they've done. I could also be confusing that with an amusement park stock, which I listened to a podcast on that recently from Focus Compounding, although it may be both of them doing sale and leasebacks. So it's potentially there. Kind of reminds me a little bit of the Dillard's investment from Ted Weschler, where they seem to be trading at like less than the value of their real estate, but then it turned out they had a business that went on to earn a lot of money as well. So that created a lot of upside. What else we got?
SC points out rates have moved up fast. You can put your capital into treasuries. What, 5% is what I'm hearing for these kind of safe treasury rates. Yeah, it's an option. I mean, if you're one of those people who think, we're in for a world of hurt over the next year or two, I'm not a market timer, but if that's the camp you're in and you want to just wait while making 4 or 5% on your money, it's hard to fault you for that.
Yeah, I mean, it's very different to where we were at a year or two ago, where
absolutely
it was dead money. It's probably not a bad alternative.
You're still losing ground to inflation, right? What are the latest inflation figures? Do you remember? Is it still up in the 8% range?
Let's see.
But over a year or two,
we're at 6.5 now. Well, the US is 6.5.
Yeah. So
I mean, you're still going backwards. Like, you got to pay tax on that 4.5% as well, I think. So yeah.
Right.
Anyhow. But yeah, very different to zero. So that's always nice.
Yes.
Interesting. Like you could say the same. I mean, we're talking about government bonds there, but you could actually say the same for a lot of corporate bonds. Have come down quite a bit also. I'm not going to buy any, but just out of interest, I was looking at some Berkshire Hathaway energy bonds, for example, that have. You would think they're probably the last company on the planet where you wouldn't get paid, and the face value of those bonds has come down quite a bit as interest rates have gone up, which means the yield's a little juicier. There's some interesting stuff in that world too.
I'm just looking at Verizon, which is a company that kind of came across my radar from a screen recently. It's paying a 6.5% dividend. I'm pretty sure Berkshire owns Verizon, at least they did at one point, but obviously the price can go anywhere in the short term. So you got to keep that in mind with with the stock, but it's compelling the yield you'd be getting from Verizon at this point.
Yeah,
not a stock tip.
Yeah, not a stock tip.
Do you have you talked about Hansen Technologies at all?
From
Ba.
I don't think I've ever heard of that company, unless I'm forgetting it.
Maybe it's a New Zealand company.
You're not familiar with it, Brett?
No.
Looks like it's on the ASX. I hope that doesn't mean I'm being mistaken for an Australian here.
But
but no, I'm not familiar with that one. It's coming on my radar more. I remember you mentioning it in one of your videos. Long
back.
Maybe.
You're losing your memory here, Tom?
Yes. I don't remember that. I've certainly mentioned Hansen Natural Beverage in previous videos, which of course went on to become Monster Beverage. But that's a very different situation. It looks like this is some sort of software business, which is up 3,500% from the early 2000s. So
that's not bad.
Yeah, I reckon you'd take that if someone offered it to you.
Yeah.
Here's an interesting maybe follow-up to the cloning conversation.
Sure.
From Art of Value, an Uber Cannibals only portfolio would be interesting, say over 10 years.
Yeah, what's your take on that, Tom? The Uber Cannibals portfolio. I think it seemed like in the free lunch portfolio, like all 5 Uber Cannibals were like insurance companies. Am I remembering that correctly? I don't know if you've taken a look at that. Maybe we could pull it up with the current free lunch portfolio as Chai with Pabrai.
Yeah, I'll see if I can find it. And I know Pabrai did a talk relatively recently on cannibals and kind of went through NVR and everything.
He did,
right?
Yes.
Yeah, so we've got Assured Guarantee, Primerica, Jack in the Box, Navient, and Discover Financial Services.
Okay, so yeah, not all insurance.
Yeah.
Yeah.
I don't know. Price obviously matters a lot with buybacks in terms of their effectiveness. And I think Pabrai pointed out pretty well that you really need to be buying businesses that are still around or ideally much larger,
right?
In 10 years.
Yeah.
You're just sort of buying back something that's on its way to zero over a long enough period of time.
Then you're just going to zero anyway.
I think so.
Yeah.
Yeah.
Yeah, it's a lot harder for me to get comfortable with that Uber Cannibals basket in the free lunch portfolio than either the spawners or the shameless cloning bucket. So that's my take.
Yeah, okay.
But I'm sure you could do it, right? There's many ways to the promised land, and I'm sure a thoughtful investor could put something together for a cannibal portfolio.
Yeah. I mean, the other trouble is, I mean, obviously there's examples and there's not that many of them really, but there's examples of companies like NVR, which have just purchased back consistently and it's worked incredibly well. But, I mean, the underlying business for NVR grew a lot too. And they also were pretty unusual in the fact that they probably traded ballpark 10 times earnings for forever. Which meant they could buy back a lot of stock. Whereas
the opportunity was consistently there, right?
100%, yeah. I mean, whereas if you look at something like Apple, for example, that was the situation. It was maybe even a little cheaper than that, I think, if you backed out the cash when Buffett was getting into it and that sort of thing. But when it's getting up to 25, 30 times earnings, the power of the buyback just falls off a cliff.
Totally.
Yeah. So I'm not sure on that one.
Yeah, so ideally, you'd really have to find sort of an out of favor company that's trading cheaply, that kind of knows it's a hidden gem and can kind of stay a hidden gem for a while as it continues to eat itself. So I think it's pretty rare to find an opportunity like that.
Yeah. And ideally, you want people running those things like a Buffett who's only going to buy it back when it's cheap. And then there might be a situation where you have an uber gainable portfolio and the company doesn't buy back a single share because the stock went up. So I don't know. It's tough. Got an interesting comment here from Alexander. Norbert Lu owns mostly Cannibal, Smith & Wesson, Ally, Winnebago. I know Smith & Wesson and Ally. Ally is a huge Cannibal, I think, last time I looked at it. Is that one you're familiar with?
No, I keep seeing it in value circles, but it's a financials company, right? I haven't looked into it.
Yeah, and I want to say Berkshire has a really sizable position at this point as well. I might just check that.
Yeah, I'm going to look at Norbert Lu's
10%.
portfolio a little more closely now through the Cannibal lens. Now you got me curious, Alexander.
Yeah, I'll bring up the shares outstanding for Ally because it's pretty impressive. That one. Not sure what happened back in these early years. I don't know if they've had some sort of business model change, but the last few years they've eaten a pretty big chunk of themselves.
Yeah, pretty big.
Yeah. And I think if we go... Yeah, they've eaten even more in the last 12 months. They're down to 300 million shares, I suppose that is.
Wow.
More recently. So, yeah, that's a huge buyback.
Mm-hmm.
What were the other ones mentioned? There was
Smith & Wesson.
Is that SWBI?
I think so. Yeah.
What I always find hilarious is if you go back through some of the Value Investors Club write-ups, you see Norbert Lu talking about NVR eating itself, and he gets really mad about how much more they could have bought back if the CEO didn't issue himself so many stock options. I always find that kind of funny.
Yeah, makes a big difference.
Yeah. So I guess this is a more recent one where they've started buying back
just in the last year or so.
Yeah, so down to 47 million and a little bit more again. Not quite on the graph though.
What's the price done in the last year? I'm curious.
Down
there you go.
40%.
You should still be buying pretty aggressively, I would guess.
Yeah. What was the other one mentioned? Winnebago.
Right.
I didn't think Winnebago were a huge repurchaser, but maybe I'm wrong on that. Yeah, not really. A little bit. Just while we're here, we might as well bring up the greatest to ever do it. Just to remind the people. This is a real Cannibal. You'd love to see it.
Wow.
It's flattened out a lot though, hasn't it? Really?
Yeah.
The buybacks have slowed.
I imagine the price has gone up and it's become less attractive to buy back shares.
Yeah, I'm actually not sure if that's completely the case. It definitely did go up.
What do the multiples look like?
Well, yeah, it went up through here. Early 2000s, it was under 10 times earnings for a long time, but we can't go back that far. It's been more
back
like
there
20. Now. Yeah, I suspect that's from high earnings rather than a low price, although there may be some low price element to that too. Interesting.
Yeah. We got a question from Mr. Muzzle. Have either of you looked much at Israeli stocks?
What time was that question, Brad?
What time? 9:41. It's probably different for you. Let's go with the 41.
Yeah, that's all I'm after. Yeah, here we go.
I think I remember I was listening to a podcast with Guy Spear, and he was talking about like the geopolitical risk in Israel and how that really kept him away from that market. That's something I think about. I've never bought an Israeli stock, and I'd be hesitant because of just where it is, how much risk there is for conflict.
Yeah.
What are your thoughts on that?
Open to it, I guess. I don't know if I've ever looked at a single company in Israel, so yeah. That
Wix is an Israeli company. I think that's one that Rob Van All owns.
Yep. Interesting.
You're being welcomed into the Turkish market here, Tom. Eunice is going to show you around all his portfolio positions, companies.
Yeah. I know a guy. I can start saying that on podcasts, can I?
That's right.
Okay. We won't mention his name in those podcasts and things because we don't want Eunice to be overwhelmed, inundated with requests for company tours.
No, I think he's in Wisconsin now. So.
Okay.
Yeah.
Yeah. He's on the ground in spirit.
Yes.
Just not physically. Yeah.
That's right.
All right. What else we got?
What else? PATK. I don't even know what that is. What is that? Hopefully I haven't talked about it before, and I'm pulling a Tom. I'm blanking.
Brad, you told me to buy it. Patrick Industries, is that the stock?
Patrick Industries. Auto components. That's not something I've ever looked at before. It is in Indiana where I was born. Maybe that's the connection here. Yeah. What do you know about it? Let us know in the comments.
Yeah, 15% CAGR for 18 years.
Hey, that's not bad.
That's no dividends.
I wonder as well. This may have turned up when I was doing research on 1,000 baggers. It was sort of one of those weird ones that I'd never heard of before.
Right.
Maybe that's where that's coming from. What else?
That has grown. That's gone from revenue in 2002 was 308 million, and they're at 4 billion today.
Not bad. Not bad.
Wow. Revenue. If I've got my decimal points and things right here. Net income in 2002, $90,000, I think, if I'm doing that right. 0.09 of a million. Have I done that correctly? $90,000.
Yeah.
To 225 million in the most recent year. That'll help.
That's impressive growth right there.
Yeah, interesting. Never heard of the company. It is, still only a market cap of 1.5 billion after all of that growth.
Where'd you find this idea?
Bar needs to tell us where he tracked this down. He's telling me it's in my alley.
It was written up on Value Investors Club back in 2013. So somebody did well on it.
Well, yeah, they were right. Did they win one of the $5,000 prizes or not?
Yeah, I think, unfortunately, I think they're 1-year prizes with VIC, which doesn't seem like the
Yeah,
best way to structure it. But it's also hard to run a competition for multiple years and keep people interested. So you know what that's
true.
about, right, Tom?
Certainly do. Yes.
Yeah.
All right. Should we
It's
take one or two more
Australian.
questions
Okay.
here?
It's Australian. Yeah.
What the company we were just looking at?
Well, I think that's what Ba is saying. It looks like it was US based to me. Maybe we're talking about different companies.
Yeah, it's saying it's working in US, China, and Canada industrial markets. I think that software company from earlier was Australian.
Gotcha.
Yeah.
What, Hanson Technology or something?
Yeah. All right. If people have got final questions, pop them in the chat. Let's maybe take one or two more, Brad, if that's good with you.
Do you know anything about the Daktronics situation with Connor Haley's Altifox Capital? Does that ring a bell?
Is that the Australian company that they had to file for?
I don't know what Daktronics is. Looks like it's in South Dakota in the US. So I don't know. You know, Altifox isn't a company I follow super closely. It seems like they do a lot of kind of activist stuff, and that's not super up my alley.
I think Frank's a fan. Follows him pretty closely, but haven't looked too much at it. Brad, you more comfortable with Turkey than Israel?
That's a good question. If you look at my portfolio, it seems like I am, but that's a funny way to frame it.
Right.
Have you looked at Naked Wines recently, Tom?
Not well.
I mean, no. I think it's been tanking, hasn't it?
Yeah, last year it got absolutely crushed, I'm pretty sure.
And I think it's continued to get crushed.
Yeah, it's down 85% from the peak.
Yeah.
Yeah.
Not something I've looked at further.
Yeah, they had some sort of issue where I think the auditors didn't really agree with them that they were a going concern, something along those lines, which is not good.
No.
And
not good for business.
Yeah. I mean, even before it fell off a cliff and they ran into that issue, I kind of put it in the too hard basket. It's similar in a way to the issue I have trying to analyze Netflix, where Netflix, you can make a pretty strong argument that the owner earnings are really high. It's just that a lot of those earnings show up in a growth in like a content library over time, whereas the free cash flow is a little lower. I think Naked Wines here can make a similar argument. They had this concept of standstill EBIT, which basically says if we spend enough on marketing and so on just to maintain our customer base, this is what our EBIT would be. But in practice, it's actually a lot lower because they are spending to grow and that type of thing. So, yeah, in both of those situations, I just had trouble kind of getting my head around it, particularly when I can go and look at, I don't know, I view Apple or something as the exact opposite, where, they can keep growing and all that type of thing, and they kind of just print money along the way.
Right.
I would prefer that. I think there's like might have been a Munger story. I'm going to be really off on the details, but it was something to the effect of, we have this guy that runs a quarry business or something. That's probably not even what it was, but they were, talking to him about, where's all your profits at the end of the year? And he said, it's sitting in the yard in those trucks over there or something. It's kind of like that idea to me. And I think Munger said he doesn't really like those types of businesses. So.
Yeah.
Anyhow, that's where I'm at with Naked Wines. Haven't looked too closely. I mean, I'd trial the product if they were in New Zealand. Didn't get an opportunity to do that. But,
yeah. Oh, you can't get it there?
No, it's in Australia.
Okay.
Pretty sure it's still not in New Zealand. Yeah. I think the US seems like it's going to dictate.
Yeah.
Yeah, the longer term for.
I think they're moving their headquarters here. Yeah, I remember Bill Brewster saying, he tried it and he was unimpressed with the product, and that kind of turned him off from looking further. But
yeah,
they may have changed some things since then.
Yeah, punch card analyst joined the board of Naked Wines, then quit after 2 weeks. Probably a bad sign. Yeah. Did Norbert Lou? I don't think sold though. And
I think he's still in. I think he's still in.
Unless I've missed that news. Could be great news that he was only on the board for 2 weeks. Maybe he sorted it all out. I don't know.
Yeah, it's still in there. He added as recently as June of last year. Right. But I think the price has gotten punished quite a bit since then.
Yeah, since June, down over 50%.
I wonder. Oh, yeah. So he still owns, it looks like 11, just under 10%. So I would think if he made a change, he would have to report on it pretty quickly.
Yeah, you'd think so.
Yeah.
And just a quick comment on AltaFox with Connor Haley. Connor Haley from AltaFox was consistently one of the top performing investors on Microcap Club. And I guess that's where he sort of built his reputation.
That sounds right.
Yeah. Cool. Let's take maybe one more. This will be a good one to end on. I'm interested to hear your thoughts on this. I don't know if we've talked about this one before, Brad. Have you looked at Spotify?
I have not. Believe it or not, I still use Pandora. I've never switched over to Spotify. I'm a little embarrassed to say that, but not that much. So I don't know much about Spotify other than I use it sometimes for listening to podcasts. But I think I tend to use the Google podcast player because I can do like 1.5 speed. I don't know that I've easily seen how to do that on Spotify. Maybe I'm thinking of some other platform, but I don't have a take. How about you, Tom? You've spent some time on Spotify, haven't you?
A little bit, yeah. I had Jeremy Deal on a podcast last year, I think it was, talking about Spotify in a fair bit of depth, which prompted me to look at it. But yeah, too hard basket. I think they give away roughly 2/3 of their revenue to the record labels right out of the gate, and they don't seem to have shown the operating leverage as they've grown that you might expect them to show. So yeah, not ruling it out. I know. I think John from the Art of Value here was talking about Spotify a little bit earlier. I think he likes that company, but yeah, in the too hard basket for me.
Okay,
I use Apple Music as
okay.
well, so I'm also not a Spotify user.
Right. Well, there you go. Something on ASOS popped up from two guys. It looks like. Do you have a take? Have you looked at ASOS recently, since it's also just like Naked Wines been tanking? I know we did a little bit on it last year. Have you looked at it again? Have you revisited it?
No, it's another one of these ones that went in the too hard basket. Yeah, I really struggled with the kind of competition in the industry, like who was going to win between ASOS and Boohoo and Shein and whoever else is kind of in that sort of space, or whether they can all exist in harmony and do very well. I just don't know how to answer that question. I'm pretty sure the CEO left as well, which doesn't help. So.
Right. Yeah, I know a guy in the UK. I guess he's got like a Bloomberg type access. And it looks like Nick Sleep, or at least Iggy Foundation, still owns ASOS. So even through this crazy drop in price, there's been no change to the number of shares held by Iggy. So could be something to look at. But much easier for me to wrap my head around things like Costco and Berkshire, and starting to get there on Amazon.
Nice. Brad, is it Iggy or is it IGY?
It's probably IGY.
Yeah, I don't know.
It's so much easier to say Iggy.
It's Iggy now.
Yeah, it's Iggy.
Yeah.
Absolutely.
We should contact Nick Sleep and tell him we've changed his charity name to Iggy. I do know with ASOS you really don't have to work that hard with the maths to make it look cheap, but that's a bit of a trap.
I mean, the maths is all based on looking in the rear view mirror, right? What are they going to do going forward? That's the big unknown.
Exactly. I mean, there's such a razor thin margin business, though. I guess is what I'm saying, that if they go, I don't know what they're running at the moment, but if they went from a 2% operating margin to a 3% operating margin, which I think they've been at in the past, their revenue growth had been quite steady, but their earnings have been all over the place because of small little changes in their very thin margin each year. You don't have to make too heroic of an assumption for it to look cheap with a tiny smidge of margin improvement, but too hard.
Yes, I think, did Hamish go in on ASOS a while back? I thought he made a video about it. I'd be curious to hear his kind of updated take on it.
Yeah, I think he made a video going in and out of ASOS. I think it was a small position. Yeah, okay. Small position. I think he was not a fan of the management change and possibly a couple of other things. I'm pretty sure the CEO left a week after he invested or something. It was quite unlucky timing.
Right.
So gotcha. I'm pretty sure that's where he's at with it. Right, cool. Brad, should we wrap it up there?
Let's wrap.
Cool. Thanks everyone for tuning in. Hopefully there'll be more than two of us here next week. Although, as I say that, if the weather's good next week, I'll probably be fishing. But hopefully there'll be four others here. So thanks, Brad. This was fun. We haven't done just the two of us.
It was good. For a while, brought me back.
Yeah. Back to the good old days. Yeah,
that's right.
Exactly. Thanks everyone for watching. This was a fun episode, and we'll see you all next week.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.